Hey, welcome back to Everything Money. We're so happy you joined us today. As always, it's Seth. No Mo today. We're talking more of a simplistic video for you out there. This is one of the most asked questions, Paul. Not asked questions we get about our 8-pillar system. What do you do when you have a company that meets your criteria? We use our 8 pillars as a high-level screener to look at these companies. And once we get our 8 pillars, now what? Where do I buy? Where do I sell? If I buy low and it rises, where do I exit my position? All this might seem kind of confusing. I am still kind of confused by this, so I'm happy you're here. Today, we're going to look at Apple, an amazing company. You know it, you love it, Paul. I have 17 iPads, 3 iMacs, I have all the phones, I got it all. I got all my Apple.
Can I ask a question? Do you really have 17 iPads?
I have 4. Now I use 2 for business.
Okay, because you said 3 iMacs, I was like, well, maybe he does have 17 iPads.
I do have 3 Apple computers, 4 iPads, and 3 phones, actually. So, yeah. So anyway,
who has a third phone?
Once one of our phones dies out, we use it as our landline at home.
Great idea.
So, yeah. Anyway, but guys, listen. So we're going to look at Apple, look at the 8 pillars, and see how it comes out. Then after that, we're going to use the amazing Everything Money Stock Analyzer tool. This tool is coming out very soon, and it's going to help you make assumptions to find a price target that you might want to buy. And again, the assumptions are up to you. Uncle Paul is going to teach you how to fish, not throw you fish. And so, just like Jesus, Paul.
I would like to throw fish, actually.
You and him are from the same region of the world.
Yeah, we are from the same region of the world.
Born right in the same, very close to Paul.
Some people, when I get a beer, they say, Jesus?
Yeah, Paul of Nazareth. Paul of Nazareth will show you the stock analyzer tool right now. So check it out, Paul.
Paul of Baghdad.
Let's talk about Apple.
Okay, so, one of the things, so a lot of people also ask me, Paul, what books do you read about investing? So one of the books that Gary Mashuris told me to read was Philip Fisher's Common Stocks and Uncommon Profits. I'd heard about this book for several years, decades, whatever it is. I never read it. I personally loved it. And the reason being is he really talks. So in Warren Buffett's early days and in Ben Graham's Security Analysis and Intelligent Investor, they were very big on finding what they called like cigar butts or cigarette butts, the very last puff of a cigar or cigarette that you could make a lot of money on. It had one final hurrah in the company, but you could buy it for so cheap that you made a ton of money.
Okay.
Philip Fisher kind of brought into the idea of, well, wait a second. Instead, buy good companies that have good prospects, good management teams, good margins, and have good growth potential, and buy them at good prices. So he wrote this book. In this book, he has 15 points that you have to actually go through. Now, it doesn't mean all 15 points have to hit. But once you are done, and we're going to do the whole analysis from beginning, and then I'll go through the 15 points. But once you're done analyzing a company that hits a sort of high-level area, okay, we're going to do the stock analyzer. We do the 8 pillars. Then we do the stock analyzer tool. The stock analyzer tool might tell us, okay, you're pretty close to the price, or you're at the price you need to be, or lower. Great. Now use Philip Fisher's 15 checkpoint list and determine through more research, through Scuttlebutt, which is nowadays Scuttlebutt's more of go on the internet, see what people are saying about the company, see the recent news, things like that, to determine which companies if that company has specific parts that you really enjoy and has a majority of the 15 points. So we want to pick Apple. And the reason we want to pick Apple is Apple's 8 pillars are phenomenal, except for 2. Which 2 are that, Seth?
Well, you call them the metric 2, right? Or
the valuation, like the
valuation.
Yes.
Yeah. So
the 2 valuation metrics are PE and price to free cash flow. Those are both excellent. So let's go look at Apple right now using our software. Okay, so we have Apple here. We have a $2 trillion market cap. We have a PE. Like I said, a valuation metric, 29, that's an X.
Which is a bit high for our standards.
And by the way, I got my profit margin idea from Philip Fisher's book. Okay. He likes looking at profit margin in a sense there. So this is 23.45% bottom line profit margin, which is phenomenal, okay? Then we go to our income statement. And again, Apple's got growing income year in and year out, revenue here. 220, 325, check mark there. Profit, same thing, guys. Big profit growth, 45 to 76. To skip ahead, we go to the 8 pillars. Assume you've done all the 8 pillars, or go to our software. we do the work for you, right, Seth?
Yep,
so for 80 cents a day,
right,
you have this software. It does a lot of the work for you. And as time goes on, we're going to make the software better and better about doing more and more work for you so you can concentrate on finding good opportunities.
So if you want the software behind Paul, click the link in the description below to join our Patreon. You can get this right now. Go ahead, Paul.
Okay, so the two metrics here I didn't like were the valuation metrics, price to free cash flow and PE. Everything else was a good check and a solid check. So I go to my stock analyzer tool right over here. And I'll go in here and I'll make my assumptions. I'll type in Apple and it tells me the data to the right here. My historical 1-year, 5-year, and 10-year analyzed different data points. Revenue growth, share buybacks, or growth, average profit margin, average free cash flow as a percentage of revenue, etc. So, revenue growth. 9.6% a year over the last 10 years, 10.22 over the last 5 years, 21.4 over the last year. It actually has growing revenue, which is kind of surprising for
a big company.
Such a big company. That's a very surprising factor. Right. Now, I'm a value investor. I'm going to make much lower assumptions than most people would do. However, for the sake of arguing about what a reasonable amount would be, let's look at the data and say, okay, let's pick what do we think it's going to do over the next 5-7 years? So
I think we would argue that we want you at home to understand the idea of value investing is simply just buying $1 for less than $1, much less than $1.
Making conservative assumptions. Yeah. So in this case, so you want me to do a value investing approach to this?
Sure.
So in this case, I'm going to sit there and say, listen, it's Apple, it's wonderful, but growth is not going to be the same next 7 years than it was in the last 7 years. So I'm going to assume 7% revenue growth, okay? It's not terribly high, it's not terribly low. Share buyback. Now, here's the thing about Apple. They're buying back a lot of shares. Look at this. In the last 10 years, they've averaged 4.73% a year. The last 5 years, 6.34. In the last year, they did 2.88% buyback. That's why it's a negative, because they're decreasing their share count by this much per year. So I think that's going to keep going. I'm going to assume 5% buyback rate, okay? Net present value, NPV. This is basically the return you would want to get on the investment. Historically, 10%, right? But as a value investor, maybe you want to have 12% return or 15 or something like that. Future PE for Apple, I think for how big of a company it is, 15 PE is normal. Profit margin. Guys, it's pretty much stuck in this 22 to 24% range, right? So I'm going to sit there and say 22%. Free cash flow as a percentage of revenue, it's basically the 25 to 26% range. Let's call it 25. And multiple of free cash flow, again, 15 times free cash flow for historical average. Because over long periods of time, free cash flow and net income earnings should be about the same. How many years of analysis do you want? 7. I hit analyze, and it's going to give me values between $53 and $60. Okay.
The price is currently $130.
$130. So it's quite a bit higher than we want it to be, which, by the way, makes sense based on their PE and other factors here, right?
So just 2 years ago, it was well within this range.
Correct. And the PE is about 28. Cut that in half, and it's about 14. Makes sense, right? So we're sitting there, and it's nice when all of these things jive out. It's confusing when you might have a PE of 17 and the stock needs to fall a lot. But at the end of the day, the stock analyzer tool is just taking your inputs and just using math. Okay, if you bought a business in full and you paid X price for it, and you assume these assumptions going forward, how much money would you make?
If you go back to stock analyzer, Paul, you have to make obviously sort of critical, intelligent. Do you remember Meet Kevin said when Tesla becomes the biggest company in the world 10 years from now, he's assuming a PE of 90. 70, my apologies. 70
PE, which was literally, I sent this to Gary. I sent Meet Kevin's video to Gary about this, and he just said, you owe me 13 minutes of my life back.
Yes.
And he said, I would started laughing when he said a 70 PE for Tesla as a mature company. He's just like, I just thought it was 70 PE for a growing company is a very tough thing to grasp. Has it worked? Absolutely. So all of these assumptions are based on what you do your research. You say, okay, based on the history, etc. Your next step then is, okay, I like Apple. I'm not ready to buy it yet, but I will be ready to buy it at some point. One of the best things you can do, part of our software will let you pick which metrics you want to find. So let's say, for example, you sit there and say your 8-pillar stocks. I want to find every stock that has every metric but the valuation metric.
This is cool, Paul.
Yes. So it'll show you all the ones that are similar to Apple.
Hershey, look at this, Paul.
And it keeps going. So you now be able to find the companies you love. Look, Microsoft right here, Google. These are all great companies that just need to sell at lower prices. And these are important to look at, Seth, because we want to make sure that we're ready to pull the trigger. And the easiest thing to happen is that stocks fall. It's harder for a company to fundamentally get better and change all the other pillars. It's easiest for stock prices to fall. So when that does happen, you want to be ready to pull the trigger. So what do you do next? Well, guys, here's a great website I saw where a guy, unfortunately, calls it Uncommon Stocks and Uncommon Profits. It's Common Stocks and Uncommon Profits, but it's einvestingforbeginners.com, and he explains all 15 Philip Fisher points on a company. I'm going to go through them, if that's okay with you. Sure. Just the title. Does the company have products or services with sufficient market potential to make possible a sizable increase in sales for at least several years? Now, most people get an answer of yes to this, and they go, I don't care what it takes.
Right.
That's what we have with all the hype stocks right now. Tesla, Square, all these companies. People just see this one question and go, oh, the answer is yes. I'll pay whatever for it.
Yep.
No. So a part of a big factor here is to look at this and determine this is a check mark for a lot of great companies.
It's not what you buy, it's what you pay.
Correct. It's not what you buy. Second one, does management have determination to continue to develop products or processes that will still further increase total sales? This is a big factor, guys. Is there growth potential in the company? Does management care about doing that? How do they do that? Sometimes for a company like AT&T, it's very difficult because of size. How do you really grow AT&T as a company when they already do $100+ billion in revenue? Mm-hmm. Very difficult. Number 3, how effective are the company's research and development efforts in relation to its size? This one I like a lot. Are they investing back in themselves to find more and more opportunities for growth? And if I said to you, hey, the company's going to spend $1 billion next year in research and development, you'd be like, well, that sounds pretty amazing. Well, what if it was Apple and they did $370 billion in revenue last year?
Very little.
Very little. What if they're a small company that did $2 billion in revenue? That's a lot. So relative to their size, are they spending adequate amounts of money? How would you determine that? Go look at other companies in their sector and see what percentage of their revenue are they spending on capital expenditures and research and development. 4, does the company have an above average sales organization? So we're getting more into the world of, now this book was written a long time ago. Mm-hmm. We didn't have internet, we didn't have marketing. So I think for sales organization, you've got to assume, are they effective marketers, right? Because nowadays, sales are very important. Sales team is very important. But that shouldn't be limited to a guy in a suit or a gal in a nice business suit going out there and saying, hi there, I'm Susie. Yeah. Would you like to buy? No, it's more about also, hey, how are they implementing online sales strategies? How are they doing other things to get sales out there? Okay? Number 5, does the company have a worthwhile profit margin? Now, this is actually one of the 8 pillars that I might be changing soon. But it's still an important one because I like to see, this is where I got the idea for profit margin when I first read this. I got the idea of, okay, I like companies with high gross margin, and gross margin versus net margin. Gross margin is for every extra unit they sell, how much that unit cost them, and the gross margin is the profit of that. So for example, Apple, as we saw before, Apple has a gross margin of 40%. That means for every unit they sell, they make 40 cents on that extra. But a bottom line profit margin of 23.5. The difference here is all the money they put into overhead, having salaries, having all these things, buildings, etc. Okay? So is it worthwhile? I look at this and say, hey, for every dollar, let's say there's 2 companies, one with 5% margin and one with 25% margin. If each one goes up $1 in revenue, which one makes more money?
The little one.
No.
Uh-oh.
The big one.
Of course,
for every dollar, they make 25 cents on that. For every dollar here, they make 5 cents. So is it worthwhile? That's a great question to ask. Now, this is not some cut and dry black or white thing. This is part of looking at the business itself. And some industries, like the grocery store industry, have very, very low margins, right? Amazon is now increasing their margins because they're doing AWS, their server business, which is very, very high margin. So like a company like Amazon that has multiple revenue streams, there's different areas will have different margins and which ones are growing, which ones are not growing, okay? So that was point number 5. Next, what's the company doing to increase and improve those margins? Are they just sitting on their laurels and going, or are they doing other things like Apple to make things, like Apple's taking their chips in-house? I'm sure that's going to increase their margins a little bit. Things like that that'll help them go through and say, hey, not only are we going to increase our sales, if we increase our margins on every unit, we're also going to make more money as time goes on. It's going to be a snowball effect. Number 7, does the company have outstanding labor and personnel relations? Now, Back in the day with a lot of factories, were there good labor relations? And in every 10K, which we'll get to soon, when they talk, every company will talk about, hey, we have our labor, we have our unions, blah, blah, and at this time, we believe we have a good relationship with our unions. You want to make sure it's a company that people want to work for, because one of the worst things to have is high turnover, where people are leaving the jobs all the time. It's really hard to get a lot of growth going. Now, the great news is a lot of great companies these days are always listed in a lot of the best places to work. Apple, Google, things like that, right? So CDW, things like that. Make sure they have at least, and as time goes on, this will change in terms of how you look at it, just like how we look at sales team. I look at sales team not just as people on the ground knocking on doors. I look at it as marketing efforts through internet and things like that. Does the company have outstanding executive relations? Now, in disclosure about my belief, I believe that a lot of investors, and I'm probably going to change my idea about this over the next 10 or 15 years. I believe a lot of investors really, really care about this. And my problem is it's too subjective. Because they'll sit there and say, do we have ethical, moral, all these things, executives? Guys, I'm not trying to be a jerk. With thousands of publicly traded companies out there, and how big these companies are. Amazon has 400, 500,000 employees. Executive teams, how big? 5, 10, I don't know how big the executive team is. I look at it going, how is it possible for them to have that many great? Now, overall, can you look at it? Sure, but how do you determine that? It's a very subjective thing.
Or skip that one. I don't like it as much.
Really?
For a normal person, I'm not definitely going to be looking at the LinkedIn profiles of all these people.
Correct. Does the company have depth to its management? Do they have a succession process? Are they just going to, if management leaves, if people have turnover, there's going to be a problem there.
If Elon leaves.
Well, that's the problem. That's the issue with Tesla. Like, Warren Buffett years ago did a good job of saying we have somebody ready, and over time he gave more and more people more and more control over the company and decision making. That way, when he passes away, because he's 90 years old or whatever, that happens. 10. How good are the company's cost analysis and accounting controls? Accounting is a big thing, guys. Are they shady with accounting? Are they good with accounting, etc.? These are very important things to understand, and you'll get a lot of that idea in a 10K, which we'll get to soon. Number 11. Are there other aspects of the business, somewhat peculiar to the industry, which will give the investor important clues as to how the outstanding the company may be in relation to its competition? This is a very common thing we talk about with companies. Go look at the sector. Go look at the industry. How do they stand within the industry? There are a lot of investors out there who won't even look at anything but the top 2 companies within industry. That's their style. More power to them. So you have to see how that company stands versus its other competitors, right?
Yeah.
Great. 12. Does the company have a short range or long range look in regard to profits? Guys, what are they thinking? Go understand what they're doing. You'll get a lot of impression from them based on not only what they say today, go look at past years. What did they say 5 years ago and did it pan out? Is it a company you can rely on and trust? Everybody jokes with me because I think analysts are a joke. The reason I think analysts are jokers is I looked at history and go, they're always wrong. And by a lot. So I don't even look at analysts. You know what I mean? Same thing here for the company. Make sure they're capable of projecting properly. In the foreseeable future, will the company require sufficient equity financing so that a large number of shares than outstanding will largely cancel the existing shareholders' benefit? Basically, are they going to dilute their investors? Will they need so much equity financing, which is money coming in from investors, that it'll dilute every other owner? This is what I always call as a silent killer, where all of a sudden that growth, if all of a sudden they grow 50%, but the number of shares they have outstanding increase 50%, you got no benefit. So that's why it's important to look at that. 14, does management talk freely to investors about its affairs when things are going well, but clam up when troubles and disappointments occur? This, to me, is the most important executive thing, management team to look at. What do they say when times are good? What do they say when times are bad? Because that's what everybody's screaming from the rooftops when times are good. But who goes back in the rabbit hole, and cowers away and says, I'm not going to talk to anybody when things are bad? Versus who comes out and says, guys, if things are bad, here's what we're going to do to change things around. Finally, does the company have management of unquestionable integrity? Again, too subjective to me. What does unquestionable integrity mean? Is the boss having an affair with, I hate to bring it up like that, but Seth, years ago, I read an article about, Fortune 500 CEOs have more affairs than even athletes. It's like, so would you not invest in any company that has, we just heard recently about Bill Gates. He built a phenomenal company that grew huge, but he was having affairs. Is that unquestionable integrity? It's all subjective. I don't know.
Yeah.
So anyways, this is an important part. Now, the next step is the 10K. The 10K, luckily for you people who spend 80 cents a day of your hard-earned money, is right here on our main page.
Oh, I didn't know that. 10K is now on the website?
It's in dev mode. It'll be put to live here very shortly.
Wow,
you go to annual reports, and it will pop up the 10K for Apple. You just click here on 10K and click on find the most recent 10K. You click on it, and bada bam, bada boom, here's your 10K. Guys, these are long and boring. I read these. Not all the time. You have to decide what kind of investor you are, right? As long as you pick a process that's value-oriented, I think you will do well, but be very, very consistent with that process. In the 10K, guys, I will show you all the things that are here. Some of these things are hundreds of pages long. Risk factors, unresolved staff comments, properties, legal, all these comments here, all these categories are here. Financials, controls and procedures. A lot of the things that you would see in Philip Fisher's list of 15 items is right here in the 10K. You'll find a lot of it here, and just Google about the company. See what outstanding litigation's out there. See what people say about the company. These are very simple things you can do. I would look at the risk factors of the company, because a lot of times they will give you hints. A lot of the risk factors are very generic. Oh, if the U.S. economy goes to zero, we will probably be out of business. Well, of course, by the way, they don't really say that, but they're very generic things. Other times they'll sit there and give very specific risk factors that they factor in there. I can't think of an example right now, but I will say about Southwest Airlines. I read the 10K and realized the value in Southwest Airlines because it was the year of the Supermax issue. They had spent $824 million on that Supermax problem. It cost them $824 million. They still had a record profit that year, and nobody looked at that extra almost $1 billion they would have made had it not been. I was like, that Supermax problem is a one-time issue. This is going to be a big. And that's what I found in the 10K. I didn't find it anywhere else. I found it in the 10K.
Wow.
So this is a summation. Thank you for doing the video. It's very long, but it's not as hard as it makes out to be. When I'm explaining it, once you do it, it goes a lot faster, right?
I think for a normal person, this is incredibly in-depth. And if you're at home wondering, again, folks, I did this for a while, and I was only ever picking stocks on the ticker price. Was it cheap, and would I think it would go up? And there's a massive amount of more information you need to learn, which you can hear on Everything Money. So if you're looking at other channels, a friend of ours, Stock Mo, who we loathe, Paul, he pulls up, all he does, folks, is he pulls up analyst predictions and then agrees with them. I mean, this is so in-depth, and using the tools we can provide you in our Patreon, you can learn.
That's the thing, the Discord. Guys, if you don't like doing this, all the more reason to join the Discord, because there are people here that you can have a conversation about specific. Guys, I'm at Apple. Did anybody read the 10K? Oh yeah, I did. Great. What'd you see that you didn't like? What'd you see that you did like, etc. That's the whole point of the community. And there's over 3,200 people in there, and it's getting a lot more organized with multiple chats about different things.
Yeah, so this is our take. That was Apple. It's a little bit overpriced now. We love all the other metrics, and we use the stock analyzer tool to find what price we like it at. So using our assumptions. So yeah, Paul, that was great. Great take, and great software you've built there. Proud to be a part of it. Take with a thumbs up. Join the Patreon. Love you guys. See ya. Thanks so much.